those of Tom Murphy, John Malone, Katharine Graham, and others, featured a single sheet of paper and an intense focus on key assumptions, not a 40-page set of projections. Sturtz, aware of the early LBOs in the packaged goods industry, consciously adopted a private equity-like mindset. His managerial worldview was neatly summarized by Mulcahy. Sturtz ran Ralston somewhat akin to an LBO. He was one of the first to see the benefit to shareholders of higher leverage as long as cash flows were strong and predictable. He simply got rid of businesses that were cash drains, no matter their provenance, and invested more deeply in existing strong businesses through massive share purchases interspersed with the occasional acquisition that met our return targets. Sturtz married nuts and bolts packaged goods marketing expertise with financial acumen, an unusual combination. He focused on newfangled metrics like EBITDA and internal rate of return, IRR, that were becoming the lingua franca of the nascent private equity industry, and he eschewed more traditional accounting measures, such as reported earnings and book value, that were Wall Street's preferred financial metrics at the time. He had a particular disdain for book value, once declaring during a rare appearance at an industry conference that book equity has no meaning in our business. A statement that was greeted with stunned silence by the audience, according to longtime analyst John Bierboos. Mauboussin added, "You have to have fortitude to look past book value, EPS, and other standard accounting metrics which don't always correlate with economic reality." Sturtz was fiercely independent and actively disdained the advice of outside advisors. He believed that charisma was overrated as a managerial attribute and that analytical skill was a critical prerequisite for a CEO and the key to independent thinking. Without it, chief executives are at the mercy of their bankers and CFOs. Sturtz observed that many CEOs came from functional areas, legal, marketing, manufacturing, sales, where this sort of analytical ability was not required. Without it, he believed they were severely handicapped. His counsel was simple. Leadership is analysis. This independent mindset translated into an innate suspicion bordering on distrust of outside advisors, particularly investment bankers, whom Sturtz once described as parasitic. He was surgical in his use of advisors, using as few as possible, always in a carefully targeted manner, and he was aggressive in negotiating their fees, holding up the multi-billion-dollar Nestle deal when he felt the bankers were overcharging him. He made a point of using different bankers for various transactions so that none felt overly secure about his business. He was well known for showing up alone to important due diligence meetings or negotiations where the other side of the table was crowded with bankers and lawyers. Sturtz relished this unorthodox approach. A then-junior banker at Goldman Sachs told me of a late-night due diligence session during the RJR Nabisco sale process when Sturtz came to a conference room at the Goldman offices alone, armed only with a yellow legal pad, and proceeded to walk through the key operating assumptions one by one before making a final bid and going to bed. He actively enjoyed the investment process, and, after selling Ralston, vigorously managed an investment partnership consisting primarily of his own capital. Sturtz jealously guarded his time, eschewing high-visibility, time-consuming philanthropic boards and avoiding casual lunches as mostly a waste of time. As he explained, it got to the point where they were taking up too much time, so I stopped them completely. He did, however, make time to sit on other corporate boards, viewing this as a unique opportunity to expose himself to new situations and ideas. He was always a fox-like sponge for new thinking, regardless of its origin. John McMillan, a longtime industry analyst, once wrote, "Some people are innovators and some people borrow ideas from others. Sturtz is both, and that's meant as a compliment." He consciously carved out blocks of time in his schedule to wrestle with the key issues in the business alone, without distraction, whether on a Florida beach or in his home office in St. Louis. He avoided time-consuming interactions with Wall Street and retained, in the words of analyst John Bierboos, a certain Garbo-like quality, rarely speaking to analysts, virtually never attending conferences, and never issuing quarterly guidance. By the mid to late 1990s, Sturtz's heresy had become orthodoxy, and virtually all his peers had implemented different versions of his strategy, divesting non-core assets, repurchasing shares, and acquiring businesses complementary to their core product lines. Not surprisingly, in 2001, just as his strategy had gained wide industry acceptance, and with packaged goods multiples at an all-time high, Sturtz abruptly changed course and sold Ralston to Nestle for a record price, once again leaving his bewildered competitors scratching their heads. A recent example, Sara Lee. The flattery of imitation by industry peers continues to this day, over 30 years after Sturtz took the helm at Ralston. The latest, and maybe last, of the consumer products companies to follow in Sturtz's footsteps is Sara Lee, which over the last 5 years, under the leadership of CEOs Brenda Barnes and Marcel Smits, has sold off non-core operations, bought back 13% of its shares, maintained a relatively high level of leverage, and generated returns for shareholders that have dwarfed its peer group. As of this writing, Sara Lee had recently declined a purchase offer for the entire company from a consortium of private equity firms at a meaningful premium to the company's prior stock price. Instead, the company announced it would spin off its highly profitable coffee and tea operations and pay a sizable one-time dividend. Sound familiar? Chapter 7. Optimizing the Family Firm, Dick Smith and General Cinema. It's remarkable how much value can be created by a small group of really talented people. David Wargo, Putnam Investments. In 1962, Philip Smith died suddenly of a heart attack. Smith had come to Boston from Russia in 1908, and, after working a variety of odd jobs, had found his way into the nascent Nickelodeon business. He worked first as an usher, advanced to ticket taker, and was eventually promoted to general manager of a movie theater in downtown Boston. In 1922, 5 years before Al Jolson broke the cinematic sound barrier, he borrowed money from friends and family and opened a theater in Boston's North End. Over the following 40 years, Smith built a successful chain of theaters, starting in New England and then expanding into the Midwest. He was a pioneer of the drive-in movie theater, and he developed a reputation as a savvy operator. A year earlier, in 1961, he had taken the company public to raise capital to build additional drive-ins. After Smith's untimely death at the age of 62, his son Dick immediately took over as CEO of General Drive-In, as the company was then known. He was 37 years old. Over the ensuing 43 years, starting with this unexceptional chain of movie theaters, this neophyte CEO simply thrashed the broader market and Jack Welch with a remarkable cumulative outperformance versus the S&P of over 11 times. Dick Smith achieved these results in the context of a publicly traded firm that was controlled by its founding family. He ran the company as though it were privately held and demonstrated unique patience in deploying the company's cash flow to diversify away from the maturing drive-in business, first into shopping mall theaters and then into entirely different business lines. Smith would alternate long periods of inactivity with the occasional very large transaction. During his tenure, he would make 3 significant acquisitions, one in the late 1960s, one in the mid-1980s, and one in the early 1990s, in unrelated businesses: soft drink bottling, American Beverage Company, retailing, Carter Hawley Hale, and publishing, Harcourt Brace Jovanovich. This series of transactions transformed the regional drive-in company into an enormously successful consumer conglomerate. The business world is strewn with the wreckage of companies that tried unsuccessfully to purchase businesses outside of their industry. Such diversifying acquisitions are notoriously difficult to execute. Think Time Warner and AOL. And yet Smith, a relatively inexperienced nepotism beneficiary, became a master of them. In fact, his tenure at General Cinema can be seen as an extended process of serial reinvention. It is also the story of a series of extraordinarily well-timed exits, one in the late 1980s and one each in 2003 and 2006. This accordion-like pattern of expansion and contraction, of diversification and divestiture, was highly unusual, although similar in some ways to Henry Singleton's at Teledyne, and paid enormous benefits for General Cinema's shareholders. Dick Smith was born in Newton, Massachusetts in 1924. He was the eldest son in a close-knit family of 4, and from a very early age worked weekends and vacations in the family business. He went to prep school in Cambridge and graduated from Harvard College with an engineering degree in 1946. He worked as a naval engineer during World War II, and after the war, eschewed an MBA to go back to work in the family business. In 1956, when Smith was 32, his father made him a full partner. After his father's death, Smith worked to aggressively expand the company's theater circuit into suburban shopping malls, where it was the unquestioned pioneer. Smith was the first in the industry to recognize that suburban theaters were the beneficiaries of strong underlying demographic trends, and in moving to capture this opportunity, he developed 2 revolutionary new practices. The first was in the area of new theater financing. The traditional approach to theater development had emphasized ownership of the underlying land, allowing for long-term control of assets and access to mortgage financing. Smith, however, realized that a well-located theater could quickly generate predictable cash flow, and he pioneered the use of lease financing to build new theaters, dramatically reducing upfront investment. This innovation allowed Smith to grow General Cinema's theater circuit rapidly with minimal capital investment. His second innovation was to add more screens per theater to attract larger audiences and to optimize high-margin concession sales. As a result of these dual innovations, General Cinema enjoyed exceptional returns on its investments in new theaters throughout the 1960s and into the early 1970s. By the late 1960s, however, Smith, realizing that theater growth was unlikely to continue indefinitely, began to explore diversification into new businesses that offered better long-term prospects. The transformational acquisition for Smith was the 1968 purchase of the Ohio-based American Beverage Company, ABC, the largest independent Pepsi bottler in the country. Smith was familiar with the beverage business through his involvement with theater concessions, and when he learned that ABC might be for sale, he moved quickly. The deal as negotiated by Smith was both compelling, an attractive price of 5 times cash flow, and very large, equaling over 20% of the company's enterprise value, EV, at the time. Smith leveraged his real estate expertise to creatively finance the purchase via a sale-leaseback of ABC's manufacturing facilities. He is still justifiably proud of this coup. Smith had grown up in the bricks-and-mortar world of movie theaters, and ABC was his first exposure to the value of businesses with intangible assets, like beverage brands. Smith grew to love the beverage business, which was an oligopoly with very high returns on capital and attractive long-term growth trends. He particularly liked the dynamics within the Pepsi bottler universe, which was fragmented and had many second- and third-generation owners who were potential sellers, unlike the Coke system, which was dominated by a smaller number of large independents. Because Pepsi was the number 2 brand, its franchises often traded at lower valuations than Coke's. In buying ABC, Smith acquired a legitimate platform company, one that other companies could be added to easily and efficiently. As ABC developed scale advantages, Smith realized he could purchase new franchises at seemingly high multiples of the seller's cash flow and immediately reduce the effective price through expense reduction, tax savvy, and marketing expertise. Acting on this insight, Smith aggressively acquired other franchises, including American Pepsi in 1973, Pepsi-Cola Bottling Company in 1977, and the Washington, D.C. franchise in 1977. As in the theater business, Smith and his team were innovative marketers and efficient operators. The company constantly sought to reduce costs, using its scale to reduce can pricing and purchasing sugar directly in international markets to avoid the parent company's markup. As a result, ABC had industry-leading margins. In addition to Pepsi franchises, Smith occasionally bought other beverage, 7-Up and Dr. Pepper, franchises, and in 1976, the company partnered with the largest orange growers co-op to create Sunkist Orange Soda, which they rolled out through their distribution network. ABC eventually invested $20 million to launch Sunkist, and in 1984 sold it to Canada Dry for $87 million, generating an exceptional return on investment. After the beverage business was established, Smith began to look for another business that could add a third leg to the General Cinema stool. Along these lines, in the late 1970s and early 1980s, the company made a number of smaller acquisitions in the broadcast media business, buying several TV and radio stations. Smith's price discipline, however, prevented General Cinema from paying the double-digit multiples then prevalent in the broadcast industry. Although it earned very good returns on its small portfolio of media investments, the company never became a major player. A missed opportunity, according to longtime investor Bob Beck of Putnam Investments. As time went on, Smith's approach to acquisitions evolved. From the early 1980s on, Smith and his team focused on the occasional large opportunistic acquisition and on a series of minority investments in public companies that he believed to be undervalued. These investments were attempts at diversification through a strategy of what Smith termed investment with involvement, the idea being to make a sizable minority investment, take a seat on the board, and work with management to improve operations and increase value. In the first half of the 1980s, Smith was involved with 3 of these investment with involvement attempts: Columbia Pictures, Hubeline, and Cadbury Schweppes. In the case of the latter 2, the incumbent management team viewed the General Cinema investment with suspicion or outright hostility. As a result, no board seats were offered, and Smith sold each of the positions within 1 to 2 years of the initial purchase. The returns from these investments were attractive, but the broader objective of diversification was not achieved. That changed suddenly in April 1985, when Woody Ives, the company's CFO, picked up his phone to find Morgan Stanley investment banker Eric Gleacher on the line with a potential third leg. Gleacher was calling about Carter Hawley Hale, CHH, a publicly traded retail conglomerate that owns several department store and specialty retail chains. Leslie Wexner, the CEO of the Limited, had recently made a hostile takeover bid for CHH, and Gleacher had been hired to find a white knight, a friendly investor who could buy a significant percentage of the stock and thwart a takeover. Ives had an initially cool reaction to Gleacher's description, but as he listened, he sensed a potentially significant opportunity. The timing was almost impossibly tight. They would need to respond by the following Tuesday, and Ives realized that any buyer who could perform to this unforgiving timetable would have enormous leverage in negotiating a transaction. Ives got off the phone and spoke to Dick Smith and the other top members of the management team. By 5 p.m., they were on a plane to CHH's corporate headquarters in Los Angeles. They spent the weekend in intensive due diligence and negotiations and emerged Sunday evening with an agreement. On Monday, Patriots' Day, a bank holiday in Boston, they hastily assembled a syndicate of 3 banks to finance the transaction, and by Thursday, a week and a day after Gleacher's initial call, the deal had closed. Smith and his management team had so refined their acquisition criteria and process that they were able to perform to this extraordinary timetable. Very few publicly traded firms could have moved so quickly on such a large transaction. The CHH investment is an excellent example of Smith's opportunism and his willingness to make sizable bets when circumstances warranted. The transaction was both very large, equal to over 40% of GC's enterprise value, and very complex. It was also very attractive. Ives negotiated a preferred security that guaranteed General Cinema a 10% return, allowed it to convert its interest into 40% of the common stock if the business performed well, and included a fixed price option to buy Walden Books, a wholly owned subsidiary of CHH. As Ives summarized to me, "At the end of the day, we borrowed money at 6 to 7% fully tax-deductible, while earning 10% on tax-advantaged debt. Plus, we got a conversion option, which eventually allowed us to peel off the Neiman Marcus Group, and the option to buy Walden Books. Not a bad weekend's work." Eventually, General Cinema would exchange its 40% ownership in CHH shares for a controlling 60% stake in the company's specialty retail division, whose primary asset was the Neiman Marcus chain. The long-term returns on the company's CHH investment were an extraordinary 51.2%. The CHH transaction moved General Cinema decisively into retailing, a new business whose attractive growth prospects were not correlated with either the beverage or the theater businesses. Smith saw 2 troubling trends emerging in the late 1980s. a newly rejuvenated Coke attacking Pepsi in local markets, and a dramatic increase in the prices for beverage franchises as the industry's favorable economics became more widely appreciated. With reluctance, he responded by deciding to explore the sale of the business, eventually selling it in 1989 to the Pepsi parent company for a record price. Following this sale, General Cinema was left with over $1 billion in cash on its balance sheet, and Smith began to look again for a diversifying acquisition. It didn't take him long to find one. In 1991, after a tortuous 18-month process, Smith made his largest and last acquisition, buying publisher Harcourt Brace Jovanovich, HBJ, in a complex auction process and assembling General Cinema's final third leg. HBJ was a leading educational and scientific publisher that also owned a testing business and an outplacement firm. Since the mid-1960s, the firm had been run as a personal fiefdom by CEO William Jovanovich. In 1986, the company received a hostile takeover bid from the renegade British publisher Robert Maxwell, and in response, Jovanovich had taken on large amounts of debt, sold off HBJ's amusement park business, and made a large distribution to shareholders. This series of moves kept Maxwell at bay, but left the company with an unsustainable debt load. As the company tripped covenants and missed payments, its debt traded down to discounted levels, and several vulture investors, including Leon Black of Apollo Investments, began to accumulate positions in the company's complex layer cake of debt securities. As operations stagnated, William Jovanovich retired and was replaced by his son, Peter, a longtime HBJ executive. In late 1990, the company hired Smith Barney to conduct a sale process. At General Cinema, the executive team dove in to analyze HBJ's complex capital structure. Despite their aversion to auctions, the management team concluded that the business fit well with General Cinema's acquisition criteria, and they decided to aggressively pursue it. They also believed that HBJ's Byzantine balance sheet, characterized by investment banker Caesar Schweitzer as an AP course in corporate finance, would likely deter other buyers, creating an opportunity for a nimble, well-capitalized independent buyer to negotiate an attractive valuation. After extensive negotiations with the company's many debt holders, Smith agreed to purchase the company for $1.56 billion, which represented 62% of General Cinema's enterprise value at the time, an enormous bet. This price equaled a multiple of 6 times cash flow for HBJ's core publishing assets, an attractive price relative to comparable transactions. Smith would eventually sell those businesses for 11 times cash flow. Table 7.1 outlines the sources and uses for the transaction, giving a sense for its complexity and the number of parties involved. Following the HBJ acquisition in 1991, General Cinema spun off its mature theater business into a separate publicly traded entity, GC Companies, GCC, allowing management to focus its attention on the larger retail and publishing businesses. Smith and his management team proceeded to operate both the retail and the publishing businesses over the next decade. In 2003, Smith sold the HBJ publishing assets to Reed Elsevier, and in 2006, he sold Neiman Marcus, the last vestige of the General Cinema portfolio, to a consortium of private equity buyers. Both transactions would set valuation records within their industries, capping an extraordinary run for Smith and General Cinema shareholders. Smith, thrust unexpectedly into the CEO spot by his father's death, posted extraordinary numbers over his 43 years at the helm of General Cinema, see Figure 7.1, generating a remarkable 16.1% compound annual return for his shareholders, dwarfing the 9% returns for the S&P and the 9.8% returns for GE over the same period. A dollar invested with Dick Smith at the beginning of 1962 would have been worth $684 at the end of the period. That same dollar invested in the S&P would have been worth $43 and $60 if invested with GE. The nuts and bolts. Smith evolved a distinctive approach to managing General Cinema's operations. He ran the company in close collaboration with a coterie of 3 top executives: Chief Financial Officer Woody Ives, Chief Operating Officer Bob Tarr, and Corporate Counsel Sam Frankenheim. He officially designated this group the Office of the Chairman, or the OOC. The OOC met weekly, and Smith actively encouraged debate among his top executives. Longtime General Cinema investment banker Caesar Schweitzer characterized these sessions as wrestling matches conducted in a constructive, collegial way. Smith was even willing to be outvoted by the other OOC members. Woody Ives, the company's talented CFO, remembers one of his proudest moments at General Cinema. Ives later left to lead a successful turnaround at Eastern Resources, when a joint venture to enter the cable business with Comcast and CBS was shot down by the board after Smith let Ives voice a dissenting opinion. He gave me permission to publicly disagree with him in front of the board. Very few CEOs would have done that. General Cinema operated with a very lean corporate staff. The company had its corporate headquarters next to one of its theaters in the rear of a nondescript shopping mall in Chestnut Hill, Massachusetts. Smith proudly notes that this suburban office space was effectively rent-free because the theater covered the rent expense for the entire complex. Smith delegated management of day-to-day operations to the OOC and the division heads, and spent little time on investor communications, which were only adequate, according to Putnam analyst Bob Beck. Instead, he spent the majority of his time on strategic and capital allocation issues. The company was run very tightly by this small group of managers. David Wargo, a longtime media investor, shared a report with me that he wrote following a meeting with management immediately after the HBJ acquisition. What's striking in the report is the crispness of the presentation, the clearly laid out rationale for the deal, and the accompanying list of specific benchmarks and return objectives, with no excess verbiage. What's also noteworthy in hindsight is that the company hit or exceeded every one of its targets. As Wargo says of the General Cinema team, "It's remarkable how much value can be created by a small group of really talented people." Smith, who had become CEO in his late 30s, was comfortable giving executives responsibility early in their careers. In 1974, Smith hired Ives, a 37-year-old investment banker with no operating experience, as the company's CFO. Similarly, in 1978, he named Tarr, a 34-year-old former submarine commander and Harvard MBA, president of the beverage division. Smith would later hire Paul Del Rossi, age 35, to run the company's theater business. Compensation for top executives was, in Smith's words, competitive but not extraordinary. However, the company did offer equity to key managers through options and a generous stock purchase program in which the company matched employee investments up to a stated maximum level. The net effect of these initiatives, according to Woody Ives, was that the executive team felt like owners. We were all shareholders and behaved as such. Smith's capital allocation record was excellent. The three primary sources of cash during Smith's long tenure were operating cash flow, long-term debt, and proceeds from the occasional large asset sale. The movie theater business is characterized by exceptional cash flow characteristics due to its negative working capital needs. Customers pay in advance, while the movie studios are paid 90 days in arrears for their films, and low capital requirements. Once a theater is built, very little investment is required to maintain it. These attractive economics had a powerful effect on Dick Smith's business worldview, and from a very early point in the company's history, he focused on maximizing cash flow, not traditional earnings per share, EPS. When I met with Smith in his office, he showed me the 1962 annual report, his first as CEO, in which he refers repeatedly to cash earnings, defined as net earnings plus depreciation, as the key metric in evaluating company performance, not net income. This may well be the first use in American business parlance of that now standard term. As longtime General Cinema CFO Woody Ives said, "Our focus was always on cash," and across Smith's tenure, the company consistently generated high levels of operating cash flow. Smith disdained equity offerings. In fact, he almost entirely avoided issuing equity from the time of the company's IPO until issuing a microscopic number of shares in 1991 to facilitate favorable tax treatment for the HBJ transaction. As he said to me, "We never issued any stock. I was like a feudal lord holding on to the ancestral land." The company did, however, make strategic use of debt to fund acquisitions. Its two largest purchases, Carter Hawley Hale and Harcourt Brace Jovanovich, were entirely debt-financed. As a result, from the mid-1980s on, the company consistently maintained debt-to-cash flow ratios of at least 3 times, leveraging equity returns and helping minimize taxes. Tax minimization was another important source of funds at General Cinema, and another area where the company had a differentiated approach. Smith, in particular, was a pioneer in this area. As the company's longtime tax advisor, Dick Denning, told me, they were extraordinarily sophisticated and not bashful about exploring and utilizing new tax ideas. The effectiveness of this tax planning can be seen in the company's low effective average tax rate of 33% over Smith's tenure, during which corporate tax rates averaged close to 50%. As we've seen, it is rare for a CEO to sell a large division or business without pressure from outside shareholders. Dick Smith, however, like several of the CEOs in this audiobook, including Bill Anders and Bill Sturritz, was an exceptional seller of businesses, 3 separate times selling large divisions for record-setting prices: the beverage business in 1989, HBJ's publishing business in 2003, and the Neiman Marcus Group, NMG, in 2006. In each case, when he saw a combination of dimming growth prospects and high valuations, he moved aggressively to sell, even if it meant substantially shrinking his company. In 2006, in the most recent example, Smith saw that further expansion of the Neiman Marcus chain would be both capital-intensive, additional new stores required $50 million each in capital, and operationally challenging. He also saw that private equity firms, flush with low-cost debt, were paying record prices for premier retail properties. He hired Goldman Sachs, and after a full auction, a consortium led by Texas Pacific Group, TPG, paid a record multiple of cash flow for the Neiman Marcus Group. The one maturing business that Smith didn't sell was the legacy General Cinema movie theater business, GC Companies. By the late 1990s, the movie exhibition business had become much more competitive. Rather than sell the theater division, Smith supposedly had an attractive offer for it in the late 1980s. The company attempted to rationalize its existing circuit to compete with the new megaplexes sprouting up around the country. It closed some theaters, expanded others, invested in new projection technology, all to no avail. By the late 1990s, GCC was no longer able to support its debt obligations and declared bankruptcy, a rare setback for Smith. Smith deployed the cash provided by these various sources into 3 principal outlets: acquisitions, stock repurchases, and capital expenditures. The company paid minimal dividends and was notable for its willingness to hold large cash balances while waiting for attractive investment opportunities to emerge. Smith's acquisitions shared several common characteristics. They were market leaders with solid growth prospects and respected brand names. They were also typically opportunistic transactions whose circumstances deterred other potential buyers. In the case of Carter Hawley Hale, no other buyer could have moved as quickly to counter the Limited's takeover bid. In the case of HBJ, no other purchaser was willing to spend the time to unravel the complex capital structure and negotiate with the manifold layers of debt holders. They were also very large bets relative to the company's size, ranging from 22% to a remarkable 62% of the company's enterprise value at the time they were made. Smith was a steady repurchaser of General Cinema's stock over time, eventually buying back 1/3 of the company's shares. His long-term internal rate of return on these buybacks was a very attractive 16%. When Hubline responded to the company's investment with involvement initiative in 1982 by buying a big block of GC's shares, Smith responded by buying back 10% of his own shares, his largest single repurchase. General Cinema maintained a disciplined approach to capital expenditures, with all capital requests requiring attractive cash returns on invested capital. The company's early suburban theaters generated exceptional returns, and the beverage division also had attractive internal investment options. General Cinema's other businesses were held to these high standards. The HBJ publishing business had very few physical assets and, as a result, low capital requirements. The Neiman Marcus business, however, had significant capital requirements. Although the retail business was more capital-intensive than General Cinema's other businesses, Smith saw in Neiman Marcus a unique brand that had been poorly run by its prior owners. Smith was willing to make the occasional large investment to open new Neiman stores because he believed that demonstrating growth potential would allow the company to realize a premium price on exit. In its 20 years of ownership, General Cinema opened just 12 stores. The new buyer would plan to open many times that number. This logic was amply justified by Neiman's stratospheric exit price. As with capital cities, a sense of infectious enthusiasm permeated my interviews with former top General Cinema executives, a sense of camaraderie and adventure. Together, this group of executives led the company into an eclectic succession of new businesses. In each, they proved themselves to be exceptional operators with industry-leading margins and exceptional returns. Smith succeeded in creating an environment where this talented group of executives was given exceptional autonomy and felt like owners. As Smith, with a gleam in his eye, summarized it to me, "We all just had so much fun." As Woody Ives said of his personal stock ownership, "I just wish I'd never sold a share." Chapter 8. The Investor as CEO, Warren Buffett and Berkshire Hathaway. You shape your houses, and then your houses shape you. Winston Churchill. The most powerful force in the universe is compound interest. Albert Einstein. Being a CEO has made me a better investor, and vice versa. Warren Buffett. Berkshire Hathaway, a 100-year-old textile company located in New Bedford, Massachusetts, had been owned by the same two local families, the Chases and the Stantons, for generations. The company, a vestige of the glory days of New England enterprise, was the unlikely target of an early hostile takeover in 1965. Hostile, at least, to the company's stubborn septuagenarian CEO, Seabury Stanton. Stanton, by refusing to meet with a large disgruntled investor, had created an unexpectedly formidable adversary. The company was ultimately taken over, after an extended proxy fight, by this most unlikely raider, a little-known, jug-eared, 35-year-old wunderkind from Nebraska named Warren Buffett. Buffett ran a small investment partnership out of a nondescript office building in Omaha and had no prior management experience. He was very different from the notorious LBO barons of the 1980s, however. First of all, he was not very hostile, having established a close relationship with the Chase family before making his move. Second, he didn't use any debt. This was a long way from Gordon Gekko or Henry Kravis. Buffett had been attracted to Berkshire by its cheap price relative to book value. At the time, the company had only a weak market position in a brutally competitive commodity business, suit linings, and a mere $18 million in market capitalization. From this undistinguished start, unprecedented results followed, and measured by long-term stock performance, the formerly crew-cut Nebraskan is simply on another planet from all other CEOs. These otherworldly returns had their origin in that aging New England textile company, which today has a market capitalization of $140 billion and virtually the same number of shares. Buffett bought his first share of Berkshire for $7. Today, it trades for over $120,000 a share. How, from such an unlikely starting point, Buffett effected this remarkable transition and how his background as an investor shaped his unique approach to managing Berkshire is a compelling story. Warren Buffett was born in 1930 in Omaha, Nebraska, where his family had deep roots. His grandfather ran a well-known local grocery store, and his father was a stockbroker in downtown Omaha and later a congressman. Buffett inherited their folksy personal style. He exhibited early entrepreneurial tendencies and pursued a variety of ventures, starting at the age of 6 and continuing through high school, including paper routes, vending machines, and soft drink reselling. After a brief stint at Wharton, he graduated from the University of Nebraska at age 20 and began to apply to business schools. Buffett had always been interested in the stock market, and at age 19 read a book called The Intelligent Investor by Benjamin Graham, which was a Paul to Damascus-type epiphany for him. Buffett was converted overnight into a value investor, following Graham's formula of buying companies that were statistically cheap trading at significant discounts to net working capital, net nets as they were known. He began to employ this strategy in investing the proceeds from his early business ventures, approximately $10,000 at the time, and after getting rejected by Harvard Business School, he went to Columbia to study with Graham. He became the star of Graham's class and received the first A+ the professor had awarded in his more than 20 years at Columbia. After graduation in 1952, Buffett asked Graham for a job at his investment firm, but was turned down and returned to Omaha, where he took a job as a broker. The first company he recommended to clients was Geico, a car insurance company that sold policies directly to government employees. The company had initially attracted Buffett's attention because Graham was its chairman, but the more he studied it, the more he realized Geico had both important competitive advantages and a margin of safety, Graham's term for a price well below intrinsic value, the price a fully informed, sophisticated buyer would pay for the company. He invested the majority of his net worth in the company and attempted to interest his firm's clients in the stock. He found this a hard sell, however, and more generally found the brokerage business to be far removed from the investment research he had come to love. He maintained contact with Graham during this period, constantly sending him stock ideas. Finally, in 1954, Graham relented and offered Buffett a job. Buffett moved back to New York and for the next 2 years worked for Graham researching net nets. He later used the colorful analogy of cigar butts to describe these cheap, often low-quality companies. In 1956, Graham dissolved his firm to focus on other interests, which included translating Aeschylus from ancient Greek, and Buffett returned to Omaha and raised a small $105,000 investment partnership from friends and family. His own net worth had grown to $140,000, over $1 million today. Over the next 13 years, Buffett achieved extraordinary results, materially beating the S&P every year without employing leverage. See Table 8.1. These results were generally achieved using Graham's deep value approach. Buffett, however, made 2 large investments in the mid-1960s, American Express and Disney, that did not follow Graham's dictates, and that presaged a larger shift in his investment philosophy toward higher quality companies with strong competitive barriers. In 1965, Buffett bought control of Berkshire Hathaway through the Buffett Partnership. He ran the partnership for 4 more years with continuing excellent results, and then in 1969, not coincidentally, the same year Henry Singleton stopped making acquisitions at Teledyne, abruptly dissolved it in the face of the high prices of the late 1960s bull market. He did, however, retain his ownership interest in Berkshire, seeing in it a potential future vehicle for his investment activity. Immediately after buying control of Berkshire, Buffett installed a new CEO, Ken Chase. In the first 3 years under Chase's leadership, the company generated $14 million of cash as Chase reduced inventories and sold off excess plants and equipment, and the business experienced a rare cyclical burst of profitability. The lion's share of this capital was used to acquire National Indemnity, a niche insurance company that generated prodigious amount of cash in the form of float, premium income generated in advance of losses and expenses. Buffett invested this float very effectively, buying both publicly traded securities and wholly owned businesses, including the Omaha Sun, a weekly newspaper in Omaha, and a bank in Rockford, Illinois. Outside Berkshire Hathaway at the same time, Buffett began to work more closely with Charlie Munger, another Omaha native and a brilliant lawyer and investor who was based on the West Coast and had emerged as Buffett's confidant. By the early 1980s, Munger and Buffett would formalize their partnership at Berkshire, with Munger becoming vice chairman, a position he still holds. Fear of inflation was a constant theme in Berkshire's annual reports throughout the 1970s and into the early 1980s. The conventional wisdom at the time was that hard assets, gold, timber, and the like, were the most effective inflation hedges. Buffett, however, under Munger's influence and in a shift from Graham's traditional approach, had come to a different conclusion. His contrarian insight was that companies with low capital needs and the ability to raise prices were actually best positioned to resist inflation's corrosive effects. This led him to invest in consumer brands and media properties, businesses with franchises, dominant market positions, or brand names. Along with this shift in investment criteria came an important shift to longer holding periods, which allowed for long-term pre-tax compounding of investment values. It is hard to overstate the significance of this change. Buffett was switching at mid-career from a proven, lucrative investment approach that focused on the balance sheet and tangible assets to an entirely different one that looked to the future and emphasized the income statement and hard-to-quantify assets like brand names and market share. To determine margin of safety, Buffett relied now on discounted cash flows and private market values instead of Graham's beloved net working capital calculation. It was not unlike Bob Dylan's controversial and roughly contemporaneous switch from acoustic to electric guitar. This tectonic shift played itself out throughout the 1970s in Berkshire's insurance portfolios, which saw an increasing proportion of media and branded consumer products companies. By the end of the decade, this transition was complete, and Buffett's portfolio included outright ownership of See's Candies and the Buffalo News, as well as large stock positions in the Washington Post, Geico, and General Foods. In the first half of the 1980s, Buffett focused on adding to the company's portfolio of wholly owned companies, buying the Nebraska Furniture Mart for $60 million in 1983 and Scott Fetzer, a conglomerate of niche industrial businesses, in 1985 for $315 million. In 1986, he made his largest investment yet, committing $500 million to help his friend Tom Murphy, the CEO of Capital Cities, acquire ABC. Buffett and Berkshire ended up owning 18% of the combined company, and it became the third of his permanent stock holdings, alongside Geico and the Washington Post. See's, the turning point. A pivotal investment in Buffett's shift in investment focus from cigar butts to franchises was the acquisition in 1972 of See's Candies. Buffett and Munger bought See's for $25 million. At the time, the company had $7 million in tangible book value and $4.2 million in pre-tax profits, so they were paying a seemingly exorbitant multiple of over 3 times book value, but only 6 times pre-tax income. See's was expensive by Graham's standards, and he would never have touched it. Buffett and Munger, however, saw a beloved brand with excellent returns on capital and untapped pricing power, and they immediately installed a new CEO, Chuck Huggins, to take advantage of this opportunity. See's has experienced relatively little unit growth since it was acquired, but due to the power of its brand, it has been able to consistently raise prices, resulting in an extraordinary 32% compound return on Berkshire's investment over its first 27 years. After 1999, See's results were no longer reported separately. During the last 39 years, the company has sent $1.65 billion in free cash to Omaha on an original investment of $25 million. This cash has been redeployed with great skill by Buffett, and See's has been a critical building block in Berkshire's success. Interestingly, purchase price played a relatively minor role in generating these returns. Had Buffett and Munger paid twice the price, the return would still have been a very attractive 21%. By 1987, in advance of the October market crash, Buffett had sold all of the stocks in his insurance company portfolios, except for his 3 core positions. After the Capital Cities transaction, he did not make another public market investment until 1989, when he announced that he had made the largest investment in Berkshire's history, investing an amount equal to 1/4 of Berkshire's book value in the Coca-Cola Company, purchasing 7% of its shares. In the late 1980s, Buffett made a handful of investments in convertible preferred securities in publicly traded companies, including Salomon Brothers, Gillette, U.S. Airways, and Champion Industries. The dividends from these securities were tax-advantaged, providing Berkshire with an attractive yield and the potential for upside, via the ability to convert to common stock, if the companies performed well. In 1991, Salomon Brothers was at the center of a major financial scandal, accused of fixing prices in government treasury bill auctions, and Buffett was drafted as interim CEO to help the company navigate the crisis. He devoted himself full-time for a little over 9 months to this project, calming regulators, installing a new CEO, and attempting to rationalize Salomon's Byzantine compensation programs. In the end, the company ended up paying a relatively small settlement and eventually returned to its former prosperity. Late in 1996, Salomon was sold to Sandy Weil's Travelers Corporation for $9 billion, a significant premium to Buffett's investment cost. In the early 1990s, Buffett continued to make selected, sizable public market investments, including large positions in Wells Fargo, 1990, General Dynamics, 1992, and American Express, 1994. As the decade progressed, Buffett once again shifted his focus to acquisitions, culminating in two significant insurance transactions: the $2.3 billion purchase in 1996 of the half of Geico that he did not already own, and the purchase of reinsurer General Re in 1998 for $22 billion in Berkshire stock, the largest transaction in the company's history. In the late 1990s and early 2000s, Buffett was an opportunistic buyer of private companies, many of them in industries out of favor after the September 11 terrorist attacks, including Shaw Carpets, Benjamin Moore Paints, and Clayton Homes. He also made a series of significant investments in the electric utility industry through Mid-American Energy, a joint venture with his Omaha friend Walter Scott, the former CEO of Kiewit Construction. During this period, Buffett was also active in a variety of investing areas outside of traditional equity markets. In 2003, he made a large, $7 billion, and very lucrative bet on junk bonds, then enormously out of favor. In 2003 and 2004, he made a significant $20 billion currency bet against the dollar, and in 2006, he announced Berkshire's first international acquisition, the $5 billion purchase of Istar, a leading manufacturer of cutting tools and blades based in Israel that has prospered under Berkshire's ownership. Several years of inactivity followed, interrupted by the financial crisis in the wake of the Lehman Brothers bankruptcy, after which Buffett entered one of the most active investing periods of his career. This stretch of activity reached its climax with Berkshire's purchase of the nation's largest railroad, the Burlington Northern Santa Fe, in early 2010 at a total valuation of $34.2 billion. So, here are those interplanetary numbers. From June 1965, when Buffett assumed control of Berkshire, through 2011, the value of the company's shares had increased at a phenomenal compound rate of 20.7%, dwarfing the 9.3% returns of the S&P 500 over the same period. See Figure 8.1. A dollar invested at the time of Buffett's takeover was worth $6,265 45 years later. A dollar invested at the time of Buffett's first stock purchase was worth over $10,000. That same dollar invested in the S&P was worth $62. During Buffett's long tenure, Berkshire's returns have exceeded those of the S&P by an extraordinary 100-fold, massively outperforming GE in the Welch era and any index of peers. The nuts and bolts. Buffett's exceptional results derive from an idiosyncratic approach in three critical and interrelated areas: capital generation, capital allocation, and management of operations. Charlie Munger has said that the secret to Berkshire's long-term success has been its ability to generate funds at 3% and invest them at 13%. And this consistent ability to create low-cost funds for investment has been an underappreciated contributor to the company's financial success. Remarkably, Buffett has almost entirely eschewed debt and equity issuances. Virtually all of Berkshire's investment capital has been generated internally. The company's primary source of capital has been float from its insurance subsidiaries, although very significant cash has also been provided by wholly owned subsidiaries and by the occasional sale of investments. Buffett has, in effect, created a capital flywheel at Berkshire, with funds from these sources being used to acquire full or partial interests in other cash-generating businesses, whose earnings in turn fund other investments, and so on. Insurance is Berkshire's most important business by a wide margin, and the critical foundation of its extraordinary growth. Buffett developed a distinctive approach to the insurance business, which bears interesting similarities to his broader approach to management and capital allocation. When Buffett acquired National Indemnity in 1967, he was among the first to recognize the leverage inherent in insurance companies with the ability to generate low-cost float. The acquisition was, in his words, a watershed for Berkshire. As he explains, float is money we hold but don't own. In an insurance operation, float arises because premiums are received before losses are paid, an interval that sometimes extends over many years. During that time, the insurer invests the money. This is another example of a powerful iconoclastic metric, one that the rest of the industry largely ignored at the time. Over time, Buffett evolved an idiosyncratic strategy for his insurance operations that emphasized profitable underwriting and float generation over growth in premium revenue. This approach, wildly different from most other insurance companies, relied on a willingness to avoid underwriting insurance when pricing was low, even if short-term profitability might suffer, and, conversely, a propensity to write extraordinarily large amounts of business when prices were attractive. This approach led to lumpy but highly profitable underwriting results. As an example, in 1984, Berkshire's largest property and casualty, P&C insurer, National Indemnity, wrote $62.2 million in premiums. 2 years later, premium volumes grew an extraordinary sixfold to $366.2 million. By 1989, they had fallen back 73% to $98.4 million and did not return to the $100 million level for 12 years. 3 years later, in 2004, the company wrote over $600 million in premiums. Over this period, National Indemnity averaged an annual underwriting profit of 6.5% as a percentage of premiums. In contrast, over the same period, the typical property and casualty insurer averaged a loss of 7%. This sawtooth pattern of revenue, see Figure 8.2, would be virtually impossible for an independent, publicly traded insurer to explain to Wall Street. Because, however, Berkshire's insurance subsidiaries are part of a much larger diversified company, they are shielded from Wall Street scrutiny. This provides a major competitive advantage, allowing National Indemnity and Berkshire's other insurance businesses to focus on profitability, not premium growth. As Buffett has said, Charlie and I have always preferred a lumpy 15% to a smooth 12% return. Float for all of Berkshire's insurance businesses grew enormously over this period, from $237 million in 1970 to over $70 billion in 2011. This incredibly low-cost source of funds has been the rocket fuel propelling Berkshire's phenomenal results, and, as we will hear, these alternating periods of inactivity and decisive action mirror the pattern of Berkshire's investing activities. In both insurance and investing, Buffett believes the key to long-term success is temperament, a willingness to be fearful when others are greedy and greedy when they are fearful. The other important source of capital at Berkshire has been earnings from wholly owned companies. These earnings have become increasingly important over the last 2 decades as Buffett has added aggressively to Berkshire's portfolio of businesses. In 1990, pre-tax earnings from wholly owned operating companies were $102 million. In 2000, they were $918 million, a 24.5% compound growth rate. By 2011, they had reached an extraordinary $6.9 billion. Now we'll turn our attention to how Buffett deploys the geyser of capital provided by Berkshire's operations. Whenever Buffett buys a company, he takes immediate control of the cash flow, insisting that excess cash be sent to Omaha for allocation. As Charlie Munger points out, unlike operations which are very decentralized, capital allocation at Berkshire is highly centralized. This mix of loose and tight, of delegation and hierarchy, was present at all the other outsider companies, but generally not to Berkshire's extreme degree. Buffett, already an extraordinarily successful investor, came to Berkshire uniquely prepared for allocating capital. Most CEOs are limited by prior experience to investment opportunities within their own industry. They are hedgehogs. Buffett, in contrast, by virtue of his prior experience evaluating investments in a wide variety of securities and industries, was a classic fox and had the advantage of choosing from a much wider menu of allocation options, including the purchase of private companies and publicly traded stocks. Simply put, the more investment options a CEO has, the more likely he or she is to make high-return decisions, and this broader palette has translated into a significant competitive advantage for Berkshire. Buffett's approach to capital allocation was unique. He never paid a dividend or repurchased significant amounts of stock. Instead, with Berkshire's companies typically requiring little capital investment, he focused on investing in publicly traded stocks and acquiring private companies, options not available to most CEOs who lacked his extensive investment experience. Before we look at these two areas, however, let's first examine a critical early decision. After a brief flirtation with the textile business, Buffett chose early on to make no further investments in Berkshire's low-return legacy suit linings business and to harvest all excess capital and deploy it elsewhere. In contrast, Burlington Industries, the largest company in the textile business then and now, chose a different path, deploying all available capital into its existing business between 1965 and 1985. Over that 20-year period, Burlington's stock appreciated at a paltry annual rate of 0.6%. Berkshire's compound return was a remarkable 27%. These differing results tell an important capital allocation parable: the value of being in business with attractive returns on capital and the related importance of getting out of low-return businesses. This was a key decision for Berkshire and makes a more general point. A critical part of capital allocation, one that receives less attention than more glamorous activities like acquisitions, is deciding which businesses are no longer deserving of future investment due to low returns. The outsider CEOs were generally ruthless in closing or selling businesses with poor future prospects and concentrating their capital on business units whose returns met their internal targets. As Buffett said when he finally closed Berkshire's textile business in 1985, "Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks." Buffett is still best known for stock market investing, which was the primary channel for Berkshire's capital during his first 25 years as CEO. Buffett's public market returns are Ruthian by any measure, and there are several different ways to look at them. As we have seen, the average returns for the Buffett partnership from 1957 to 1969 were 30.4%, and according to a study in Money Week magazine, Berkshire's investment returns from 1985 through 2005 were an extraordinary 25%. Because of its importance to Berkshire's overall returns and the window it provides on Buffett's broader capital allocation philosophy, it's worth taking a close look at one particular facet of Buffett's approach to public market investing: portfolio management. Portfolio management, how many stocks an investor owns and how long he holds them, has an enormous impact on returns. Two investors with the same investment philosophy but different approaches to portfolio management will produce dramatically different results. Buffett's approach to managing Berkshire's stock investments has been distinguished by two primary characteristics: a high degree of concentration and extremely long holding periods. In each of these areas, his thinking is unconventional. Buffett believes that exceptional returns come from concentrated portfolios, that excellent investment ideas are rare, and he has repeatedly told students that their investing results would improve if, at the beginning of their careers, they were handed a 20-hole punch card representing the total number of investments they could make in their investing lifetimes. As he summarized in the 1993 annual report, "We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it." Buffett's pattern of investment at Berkshire has been similar to the pattern of underwriting at his insurance subsidiaries, with long periods of inactivity interspersed with occasional large investments. The top 5 positions in Berkshire's portfolio have typically accounted for a remarkable 60 to 80% of total value. This compares with 10 to 20% for the typical mutual fund portfolio. On at least 4 occasions, Buffett invested over 15% of Berkshire's book value in a single stock, and he once had 40% of the Buffett partnership invested in American Express. The other distinguishing characteristic of Buffett's approach to portfolio management is extraordinarily long holding periods. He has held his current top 5 stock positions, with the exception of IBM, which was purchased in 2011, for over 20 years on average. This compares with an average holding period of less than 1 year for the typical mutual fund. This translates into an exceptionally low level of investment activity, characterized by Buffett as inactivity bordering on sloth. These two portfolio management tenets combine to form a powerful and highly selective filter, one that very few companies pass through. Interestingly, despite his historic advocacy of stock repurchases, Buffett, with the exception of a few small early buybacks, is the only CEO in this audiobook who did not buy back significant amounts of his company's stock. Despite admiring and encouraging the repurchases of other CEOs, he has felt buybacks were counter to Berkshire's unique, partnership-like culture and could potentially tamper with the bonds of trust built up over many years of honest, forthright communications and outstanding returns. That being said, Buffett is nothing if not opportunistic. On the rare occasions, two actually, when Berkshire's stock traded for extended periods at valuations well below intrinsic value, Buffett broke with tradition and explored a repurchase, as he did in early 2001, when the stock fell precipitously during the internet bubble, and more recently in September 2011, when he announced that he would buy back significant amount of stock at prices below 1.1 times book value. In both cases, the stock quickly moved up, preventing Berkshire from purchasing a meaningful number of shares. The other major outlet for Berkshire's capital has been the purchase of private companies. This channel has quietly become the primary one for Buffett over the last 20 years, culminating in the massive Burlington Northern purchase in early 2010. His approach to these acquisitions is homegrown and unique, and Table 8.2 compares it with that, not to that. Two interesting patterns. For those interested in a deeper dive into Buffett's stock market investing, two other patterns are worthy of notice. The first is a deep-rooted contrarianism. Buffett has frequently cited Benjamin Graham's Mr. Market analogy, in which an obliging fellow named Mr. Market shows up every day to either buy from you or sell to you. The more manic-depressive this chap is, the greater the opportunities available to the investor. Buffett systematically buys when Graham's Mr. Market is feeling most blue. The majority of Berkshire's major public market investments originated in some sort of industry or company crisis that obscured the value of a strong underlying business. The following table demonstrates this pattern. American Express in 1964, contrarian context, salad oil scandal. Washington Post in 1973, contrarian context, government broadcast license challenge. Geico in 1976, contrarian context, potential insolvency. Wells Fargo in 1989, contrarian context, Southern California recession and real estate crisis. Freddie Mac in 1989, contrarian context, recession, S&L crisis. General Dynamics in 1992, contrarian context, post-Cold War defense industry slump. Geico in 1976, management strategic change, focus on core insurance business, new CEO, prior holding. General Foods in 1979, management strategic change, focus on core brands, new CEO, buybacks. Coca-Cola in 1988, management strategic change, divesting non-core businesses, buybacks, relatively new CEO. General Dynamics in 1992, management strategic change, divestitures, buybacks, new CEO. American Express in 1994, management strategic change, divesting Lehman, new CEO, prior holding. The second pattern is timing investments to coincide with significant management or strategy changes. Buffett uses the analogy of a pro-am golf event to describe these investment opportunities, which arise when a company with an excellent franchise-type business invests in other businesses with lower returns. Even if all of the amateurs are hopeless duffers, the team's best ball score will be respectable because of the dominating skills of the professional. When, however, Buffett sees that a new management team is removing the amateurs from the foursome and returning focus to the company's core businesses, he pays close attention, as the preceding table demonstrates. Buffett has created an attractive, highly differentiated option for sellers of large private businesses, one that falls somewhere between an IPO and a private equity sale. A sale to Berkshire is unique in allowing an owner-operator to achieve liquidity while continuing to run the company without interference or Wall Street scrutiny. Buffett offers an environment that is completely free of corporate bureaucracy, with unlimited access to capital for worthwhile projects. This package is highly differentiated from the private equity alternative, which promises a high level of investor involvement and a typical 5-year holding period before the next exit event. Buffett never participates in auctions. As David Sokol, the now former CEO of Mid-American Energy and NetJets, told me, "We simply don't get swept away by the excitement of bidding." Instead, remarkably, Buffett has created a system in which the owners of leading private companies call him. He avoids negotiating valuation, asking interested sellers to contact him and name their price. He promises to give an answer, usually in 5 minutes or less. This requirement forces potential sellers to move quickly to their lowest acceptable price and ensures that his time is used efficiently. Buffett does not spend significant time on traditional due diligence and arrives at deals with extraordinary speed, often within a few days of first contact. He never visits operating facilities and rarely meets with management before deciding on an acquisition. Tom Murphy told me, "Capital Cities was one of the biggest investments Berkshire had ever made. It took only 15 minutes to talk through the deal and agree on terms." Buffett, the master delegator, has never, however, delegated capital allocation decisions. There is no business development team or investment committee at Berkshire, and Buffett never relies on investment bankers, accountants, or lawyers, with the exception of Munger, for advice. He does his own analytical work and handles all negotiations personally. He never looks at the forecasts provided by intermediaries, preferring instead to focus on historical financial statements and make his own projections. He is able to move quickly because he only buys companies in industries he knows well, allowing him to focus quickly on key operating metrics. As Charlie Munger has said about Berkshire's approach to acquisitions, "We don't try to do acquisitions, we wait for no-brainers." Buffett, in addition to being the greatest investor of his generation, has proven to be an extremely effective manager of Berkshire's growing, polyglot portfolio of operating businesses. Over the last 10 years, Berkshire has grown earnings per share significantly, and despite its size and diversity, the company operates with extraordinary efficiency, consistently ranking in the top quartile of the Fortune 500 for return on tangible assets. So, how does Buffett achieve these operating results? Beneath his avuncular exterior, Buffett is a deeply unconventional CEO, which is perhaps best seen by comparing his approach with that of Jack Welch, see Table 8.3, who thrived at GE with a system that emphasized centralized strategic initiatives, Six Sigma and so on, rotating CEOs, and a frenetic pace of travel and meetings. The contrast in management styles could hardly be more dramatic, although Buffett has deep admiration for Welch's abilities. Buffett came to the CEO role without any relevant operating experience and consciously designed Berkshire to allow him to focus his time on capital allocation, while spending as little time as possible managing operations, where he felt he could add little value. As a result, the touchstone of the Berkshire system is extreme decentralization. If Teledyne, Capital Cities, and the other companies in this audiobook had decentralized management styles and philosophies, Berkshire's is positively anarchic by comparison. In a company with over 270,000 employees, there are only 23 at corporate headquarters in Omaha. There are no regular budget meetings for Berkshire companies. The CEOs who run Berkshire's subsidiary companies simply never hear from Buffett unless they call for advice or seek capital for their businesses. He summarizes this approach to management as hire well, manage little, and believes this extreme form of decentralization increases the overall efficiency of the organization by reducing overhead and releasing entrepreneurial energy. In his 1986 Berkshire Annual Report, Buffett, as we heard in the introduction, described the discovery of the surprisingly powerful institutional imperative, which led managers to mindlessly imitate their peers. Cognizant of Churchill's quotation, which he has frequently cited, he has intentionally structured his company and life to avoid the effects of this imperative. Buffett spends his time differently than other Fortune 500 CEOs. managing his schedule to avoid unnecessary distractions and preserving uninterrupted time to read, 5 newspapers daily and countless annual reports, and think. He prides himself on keeping a blank calendar, devoid of regular meetings. He does not have a computer in his office and has never had a stock ticker. Buffett's approach to investor relations is also unique and homegrown. Buffett estimates the average CEO spends 20% of his time communicating with Wall Street. In contrast, he spends no time with analysts, never attends investment conferences, and has never provided quarterly earnings guidance. He prefers to communicate with his investors through detailed annual reports and meetings, both of which are unique. Printed on plain, uncoated paper with a simple single-color cover, Berkshire's annual report looks different from other annual reports. The core of the report is a long essay written by Buffett, with editorial assistance from Carol Loomis, that provides a detailed review of the company's various businesses over the past year. The style is direct and informal, and the reports are models of concision and clarity, with detailed information for each operating division and an owner's manual clearly outlining Buffett and Munger's distinctive operating philosophy. The annual meetings are also unique. The administrative portion of the meeting typically takes no more than 15 minutes, after which Buffett and Munger answer questions from shareholders for up to 5 hours. The meetings attract enormous crowds. Over 35,000 people attended the 2011 meeting, and Buffett is taken to referring to them as the Woodstock of capitalism. The annual reports and meetings reinforce a powerful culture that values frugality, independent thinking, and long-term stewardship. Also, whimsy and humor. When Buffett stepped out of character in the early 1990s and purchased a corporate plane, he dubbed it the Indefensible and disclosed it in the annual report in laughably small print. Another unconventional shareholder practice relates to stock splits. Buffett has famously eschewed splitting Berkshire's A shares, which currently trade at over $120,000, more than 50 times the price of the next highest issue on the New York Stock Exchange, NYSE. He believes these splits are purely cosmetic and likens the process to dividing a pizza into 8 versus 4 slices, with no change in calories or asset value delivered. Avoiding stock splits is yet another filter, helping Berkshire to self-select for long-term owners. In 1996, he reluctantly agreed to create a lower-priced class of B shares, which traded at 1/30th of the A shares and were the second highest-priced issue on the NYSE. In connection with the Burlington Northern deal in early 2010, Buffett agreed to split the B shares a further 50-1 to accommodate the railroad's smaller investors. All of this adds up to something much more powerful than a business or investment strategy. Buffett has developed a worldview that, at its core, emphasizes the development of long-term relationships with excellent people and businesses and the avoidance of unnecessary turnover, which can interrupt the powerful chain of economic compounding that is the essence of long-term value creation. Buffett and Sarbanes-Oxley. Buffett's approach to corporate governance is also unconventional, contradicting many of the dictates of the Sarbanes-Oxley legislation. Buffett believes that the best boards are composed of relatively small groups, Berkshire has 12 directors, of experienced business people with large ownership stakes. He requires that all directors have significant personal capital invested in Berkshire's stock. He believes directors should have exposure to the consequences of poor decisions. Berkshire does not carry insurance for its directors, and should not be reliant on the income from board fees, which are minimal at Berkshire. This approach, which leaves him with a small group of insiders by Sarbanes-Oxley standards, provides a stark contrast with most public company boards, whose members rarely have meaningful personal capital invested alongside shareholders, whose downsides are limited by insurance, and whose fees often represent a high percentage of their total income. Which approach leads to better alignment with shareholders? In fact, Buffett can perhaps best be understood as a manager-investor philosopher, whose primary objective is turnover reduction. Berkshire's many iconoclastic policies all share the objective of selecting for the best people and businesses and reducing the significant financial and human costs of churn, whether of managers, investors, or shareholders. To Buffett and Munger, there is a compelling, Zen-like logic in choosing to associate with the best and in avoiding unnecessary change. Not only is it a path to exceptional economic returns, it is a more balanced way to lead a life. And among the many lessons they have to teach, the power of these long-term relationships may be the most important. Chapter 9. Radical Rationality, the Outsider's Mindset. You are right not because others agree with you, but because your facts and reasoning are sound. Benjamin Graham. What makes him a leader is precisely that he is able to think things through for himself. William Deresiewicz, Lecture to West Point Plebe Class, October 2009. Stepping back, we can see in Figure 9.1 the value of $1 invested with the outsider CEOs versus their peers, the broader market, and Jack Welch. Pretty impressive. The numbers speak for themselves and nicely summarize the achievement of these extraordinary executives. These phenomenal records, however, were assembled for the most part last century. So the question is, are the experiences and lessons of these CEOs still relevant to managers and investors operating in today's rapidly changing competitive environment? The answer is borne out in the examples of two more recent companies, one small, Prepaid Legal, and one large, ExxonMobil. Prepaid Legal Services was until recently a publicly traded company that sold legal plans to individuals and businesses. These plans are effectively insurance products. In return for an annual premium, customers are covered for expenses that might arise from a wide range of potential legal activities, including litigation, real estate, trusts, and wills. These plans were invented in the 1970s, and prepaid legal grew rapidly throughout the 1980s and 1990s. What's interesting about the company is that after this strong initial growth, its revenues have been virtually flat over the last 10 years. This pattern of rapid growth followed by a sudden and extended flattening in results has historically been a recipe for horrific stock market returns. Over that same period of time, however, prepaid stock appreciated fourfold, dramatically outperforming both the market and its industry peers. How did the company achieve these results? Starting in late 1999, its CEO, Harlan Stonecipher, realized that his market was maturing and that additional investments in growth were unlikely to have attractive returns. At the urging of his board, which unusually for a public company included several large investors, he began a systematic and aggressive program of optimizing free cash flow and systematically returning capital to shareholders through an aggressive stock repurchase program. Over the next 12 years, Stonecipher bought in over 50% of shares outstanding, to the sustained applause of his shareholders and the stock market, and in June 2011 agreed to sell his company to a private equity firm for a significant premium. Since Prepaid Legal is a smaller, closely held company, it's important to look for another example among larger firms. A big one, a really big one, is ExxonMobil, the world's largest company by market capitalization. Since 1977, Exxon, and later ExxonMobil, has generated a phenomenal 15% compound return for its investors, dwarfing both the market and its peers, a truly remarkable record given its size. When we look at how its managers achieved these results, the similarities with the outsider CEOs are striking. A handful of lessons stand out. Always do the math. The outsider CEOs always started by asking what the return was. Every investment project generates a return, and the math is really just fifth-grade arithmetic. But these CEOs did it consistently, used conservative assumptions, and only went forward with projects that offered compelling returns. They focused on the key assumptions, did not believe in overly detailed spreadsheets, and performed the analysis themselves, not relying on subordinates or advisors. The outsider CEOs believed that the value of financial projections was determined by the quality of the assumptions, not by the number of pages in the presentation, and many developed succinct, single-page analytical templates that focused employees on key variables. In Daniel Kahneman's excellent recent book, Thinking, Fast and Slow, he lays out a model for human decision-making that evolved from his 30 years of Nobel Prize-winning research. Kahneman's paradigm features two distinct systems. System 1 is the purely instinctive pattern recognition mode that is instantly engaged in any situation and arrives at decisions very quickly using rules of thumb. System 2 is the slower, more reflective track that employs more complex analysis. System 2 can override System 1. The problem is that it takes more time and effort to engage System 2, and for that reason it is underutilized in many of us. According to Kahneman, the key to using System 2 is often a catalyst or trigger, and for the outsider CEOs, these deceptively simple one-pager analyses often served that function. They ensured a focus on empirical data and prevented blind crowd following. As such, they were inoculations against conventional wisdom, and they spread widely throughout the outsider companies. As George Roberts, Henry Singleton's COO at Teledyne, told Forbes magazine, "Capital discipline is so ingrained in our managers that very few low-returning proposals are ever presented to us." Under the leadership of CEO Rex Tillerson and his curmudgeonly predecessor Lee Raymond, ExxonMobil has exhibited similar discipline, requiring a minimum 20% return on all capital projects. During the recent financial crisis, as energy prices fell, Tillerson and his team were criticized by Wall Street analysts for lowering production levels. They simply refused, however, to pump additional oil from projects with insufficient returns, even if it meant lower near-term profits. The denominator matters. These CEOs shared an intense focus on maximizing value per share. To do this, they didn't simply focus on the numerator, total company value, which can be grown by any number of means, including overpaying for acquisitions or funding internal capital projects that don't make economic sense. They also focused intently on managing the denominator through the careful financing of investment projects and opportunistic share repurchases. These repurchases were not made to prop up stock prices or to offset option grants, two popular rationales for buybacks today, but rather because they offered attractive returns as investments in their own right. Alone among the major energy companies, ExxonMobil has been an aggressive purchaser of its own stock, buying in over 25% of shares outstanding in the last 5 years. In the teeth of the post-Lehman meltdown, the company actually accelerated its repurchases. A feisty independence. The outsider CEOs were master delegators, running highly decentralized organizations and pushing operating decisions down to the lowest, most local levels in their organizations. They did not, however, delegate capital allocation decisions. As Charlie Munger described it to me, their companies were an odd blend of decentralized operations and highly centralized capital allocation. And this mix of loose and tight, of delegation and hierarchy, proved to be a very powerful counter to the institutional imperative. In addition to thinking independently, they were comfortable acting with a minimum of input from outside advisors. There is something out of High Noon in John Malone showing up solo to face a phalanx of AT&T corporate development staff, lawyers, and accountants, or Bill Sturritz showing up alone with a yellow legal pad for due diligence on a potential multi-billion-dollar transaction, or Warren Buffett making a decision on a potential acquisition for Berkshire in a single day without ever visiting the company. Charisma is overrated. The outsider CEOs were also distinctly unpromotional and spent considerably less time on investor relations than their peers. They did not offer earnings guidance or participate in Wall Street conferences. As a group, they were not extroverted or overly charismatic. In this regard, they had the quality of humility that Jim Collins emphasized in his excellent Good to Great. They did not seek, or usually attract, the spotlight. Their returns, however, more than compensated for this introversion. Tillerson is involved in all major capital allocation decisions at ExxonMobil. He rarely participates on earnings calls or goes to conferences, and is known among the Wall Street analyst community for his laconic communication style. A crocodile-like temperament that mixes patience. Armed with their return calculations, all, with the notable exception of John Malone, who was constantly buying cable companies in pursuit of scale, were willing to wait long periods of time, in the case of Dick Smith at General Cinema, an entire decade, for the right opportunity to emerge. Like Katharine Graham, many of them created enormous shareholder value by simply avoiding overpriced strategic acquisitions, staying on the sidelines during periods of acquisition feeding frenzy. Until recently, ExxonMobil hadn't closed a significant purchase in over 10 years. With occasional bold action. Interestingly, as we've seen, this penchant for empiricism and analysis did not result in timidity. Just the opposite, actually. On the rare occasions when they found projects with compelling returns, they could act with boldness and blinding speed. Each made at least one acquisition or investment that equaled 25% or more of their firm's enterprise value. Tom Murphy made one, ABC, that was greater than his entire company's value. In 1999, at a time when oil prices were at historic lows, Exxon bought rival Mobil Corporation in a blockbuster transaction that totaled more than 50% of its enterprise value. The consistent application of a rational, analytical approach to decisions, large and small. These executives were capital surgeons, consistently directing available capital toward the most efficient, highest-returning projects. Over long periods of time, this discipline had an enormous impact on shareholder value through the steady accretion of value-enhancing decisions, and, equally important, the avoidance of value-destroying ones. This unorthodox mindset in itself proved to be a substantial and sustainable competitive advantage for their companies. It provided the equivalent of polarized lenses, allowing the outsider CEOs to cut through the glare of peer activity and conventional wisdom to see the core economic reality and make decisions accordingly. There are numerous examples sprinkled throughout the audiobook of the crispness and efficiency that resulted from this pragmatic analytical approach. These CEOs knew precisely what they were looking for, and so did their employees. They didn't overanalyze or overmodel, and they didn't look to outside consultants or bankers to confirm their thinking. They pounced. As Pat Mulcahy, Bill Sturritz's longtime lieutenant at Ralston Purina, put it, "We knew what we needed to focus on. Simple as that." In a 2009 article, Barron's described ExxonMobil's distinctive corporate culture with its relentless focus on returns at the expense of ego. Not coincidentally, this frugal culture produced exceptional results, and ExxonMobil has consistently led the oil and gas industry in return on equity over the last quarter century. A prediction. Today, the combination of record corporate cash levels and generally low interest rates and PE ratios presents a historic opportunity for aggressive capital allocation. This situation is particularly pronounced among the largest, bluest chip technology businesses, companies like Cisco, Microsoft, and Dell, many of which are still run by members of their founding management teams, have enormous cash balances, and trade at unprecedented single-digit PE multiples. I think it's likely one of these firms will reverse its historic emphasis on R&D investment and move to optimize returns through a combination of dramatically increased buybacks or dividends. Were this to happen, the market's response would likely be rapturous, and one can imagine Henry Singleton as the CEO of one of these companies, rubbing his hands together in delight at the opportunities. A long-term perspective. Although frugal by nature, the outsider CEOs were also willing to invest in their businesses to build long-term value. To do this, they needed to ignore the quarterly earnings treadmill and tune out Wall Street analysts and the cacophony of cable shows like Squawk Box and Mad Money with their relentless emphasis on short-term thinking. When Tom Murphy insisted on a huge spike in capital expenditures for a new printing plant, or when John Malone bought expensive cutting-edge cable boxes in the late 1990s, they were consciously penalizing short-term earnings to improve their customers' experiences and defend long-term competitive positions. This long-range perspective often leads to contrarian behavior. In contrast to its controversial decision to reduce production, ExxonMobil, alone among the major energy companies, resolutely maintained its spending on exploration during the financial crisis with a view toward optimizing long-term value. When other large players retrenched from the Canadian oil sands after energy prices plunged in early 2009, ExxonMobil moved forward with a large exploration project in Alberta, even though it would penalize near-term earnings. A high-profile contrast to Stonecipher and Tillerson's achievements is provided by the nation's largest financial institution, Citigroup, whose CEO, Chuck Prince, at the height of the mortgage and leverage tsunami of the mid-2000s, famously declared, "As long as the music is playing, you've got to get up and dance." Prince was transfixed by the lure of conventional wisdom, by the institutional imperative, and he and his shareholders would soon dance off the cliff as the company's stock plunged from a 2007 high of $40 to less than $3 in early 2009. During a period of horrendous market and industry performance, Prince managed to underperform both the S&P and his peers. What separated these CEOs and the performance of their companies was two distinctly different mindsets. The outsider CEOs, like Stonecipher and Tillerson, tended to dance when everyone else was on the sidelines and to cling shyly to the periphery when the music was loudest. They were intelligent contrarians, willing to lean against the wall indefinitely when returns were uninteresting. In widely varying industries and market conditions, this group independently coalesced around a remarkably similar set of core principles. Fundamentally, Stonecipher, Tillerson, and their fellow outsider CEOs achieved extraordinary relative results by consistently zigging while their peers zagged, and as Table 9.1 shows, in their zigging, they followed a virtually identical blueprint. They disdained dividends, made disciplined, occasionally large, acquisitions, used leverage selectively, bought back a lot of stock, minimized taxes, ran decentralized organizations, and focused on cash flow over reported net income. Again, what matters is how you play the hand you're dealt. And these executives were dealt very different hands. Their circumstances varied widely. Those facing Bill Anders after the fall of the Berlin Wall could not have been more different from those facing John Malone when he took over TCI during the cable television boom of the early 1970s. The key is optimizing within given circumstances. An analogy can be made to a high school football coach who every year has to adapt his strategy to the changing mix of players on his team, i.e. with a weak quarterback he must run the ball, or to the head of a repertory theater company who must choose plays that fit her actor's unique mix of talents. There is no strict formula here, no hard and fast rules. It does not always make sense to repurchase your own stock or to make acquisitions or to sit on the sidelines. The right capital allocation decision varies depending on the situation at any given point in time. This is why Henry Singleton believed flexibility was so essential. As a group, these CEOs faced the inherent uncertainty of the business world with a patient, rational, pragmatic opportunism, not a detailed set of strategic plans. Their specific actions stemmed from a broader, shared mindset and added up to nothing less than a new model for CEO success, one centered on the optimal management of firm resources. Although the outsider CEOs were an extraordinarily talented group, their advantage relative to their peers was one of temperament, not intellect. Fundamentally, they believed that what mattered was clear-eyed decision-making, and in their cultures they emphasized the seemingly old-fashioned virtues of frugality and patience, independence and occasional boldness, rationality and logic. Their unorthodox approach proved a robust source of competitive advantage across a wide variety of industries and market conditions. Fundamentally, as Table 9.2 demonstrates, these executives practiced a sort of radical rationality. They had the perspective of the long-term investor or owner, not the high-paid employee, a very different hat than most CEOs wear to work. So, back to the question at hand. For whom are the experiences and lessons of these CEOs relevant? The short answer is virtually any manager or business owner. The good news is that you don't need to be a marketing or technical genius or a charismatic visionary to be a highly effective CEO. You do, however, need to understand capital allocation and to think carefully about how to best deploy your company's resources to create value for shareholders. You have to be willing to always ask what the return is and to go forward only with projects that offer attractive returns using conservative assumptions. And you have to have the confidence to occasionally do things differently from your peers. Managers and entrepreneurs who follow these principles, who commit to rationality and to thinking for themselves, can expect to make the most of the cards they're dealt and to delight their shareholders. Postlude. Old dogs, old tricks. If you can keep your head when all about you are losing theirs. Rudyard Kipling, If. As the Nobel Prize-winning chemist Louis Pasteur once observed, chance favors the prepared mind. And speaking of prepared minds, let's conclude by looking at how the two remaining active outsider CEOs, Warren Buffett and John Malone, navigated the financial meltdown that followed the September 2008 collapse of Lehman Brothers. As you would expect, both pursued dramatically different courses from their peers. At a time when virtually all of corporate America was sitting on the sidelines, shepherding cash, and nursing ailing balance sheets, these two lions in winter were actively on the prowl. Buffett, after a long period of relative inactivity stretching back to the immediate aftermath of 9/11, has had one of the most active periods of his long career. Since the fourth quarter of 2008, he has deployed over $80 billion, over $15 billion of it in the first 25 days after the Lehman collapse, in a wide variety of investing activities. Purchased $8 billion of convertible preferred stock from Goldman Sachs and General Electric. Made a number of common stock purchases, including Constellation Energy, $9 billion. Provided mezzanine financing to Mars Wrigley, $6.5 billion, and Dow Chemical, $3 billion. Bought various distressed debt securities in the open market, $8.9 billion. In Berkshire's largest deal ever by dollar value, bought the 77.5% of Burlington Northern that he didn't already own for $26.5 billion. Acquired Lubrizol, a leading publicly traded lubricant company, for $8.7 billion. Announced a sizable $10.9 billion new investment in IBM stock. Over the same period, John Malone has been quietly conducting an extended experiment in aggressive capital allocation across the disparate entities that were spun out of TCI's original programming arm, Liberty Media. In the depths of the financial crisis, Malone implemented a leveraged equity growth strategy at satellite programming giant DirecTV, increasing debt and aggressively repurchasing stock, over 40% of shares outstanding in the last 24 months. Initiated a series of moves across the former Liberty entities, including the spin-off of cable programmer Starz Encore and a debt-for-equity swap between Liberty Capital, owner of Malone's polyglot collection of public and private assets, and Liberty Interactive, home of the QVC shopping network and other online entities. Swept in and bought control of Sirius Broadcasting, the satellite radio service, through Liberty Capital, in a distressed and extremely attractive transaction at the nadir of the market in early 2009. He also bought back 11% of Liberty Capital's shares in the second quarter of 2010. Through his international cable arm, Liberty Global, announced the company's largest acquisition ever, the purchase of German cable company Unity Media for over €5 billion, less than 7 times cash flow, as well as the sale of its sizable stake in Japan's largest cable business for over 9 times cash flow, with all proceeds sheltered from taxes by the company's enormous pool of net operating losses. He also continued Liberty Global's aggressive buyback program. The company has repurchased over half its shares in the last 5 years. Phew! So while corporate America generally stood frozen on the sidelines, these two wily CEOs engaged in an orgy of Keynesian animal spirits. They were, to qualify Buffett's dictum, very greedy at a time when their peers trembled with unprecedented fear. Epilogue. An example and a checklist. Let's conclude with an example that shows the outsider approach at work in a different setting. Suppose you own a successful high-end bakery, specializing in baguettes and fresh pastries. The key to your success is a special oven manufactured in Italy, and you have the high-class problem of more demand than you can keep up with. You are faced with 2 choices for growing the business: expand into the space next door and buy a second oven, or open a new store in a different part of town which also requires a new oven. A competitor of yours in a different part of the city has recently expanded its store with great success, and you've recently read about a publicly traded baking company that has grown through carefully enlarging existing stores. Conventional wisdom points to expanding your store as the right path, but you sit down and do the math. You start by calculating the upfront cost and likely revenues and profits for each scenario, using what you believe to be conservative assumptions. You then calculate the return for each, starting with the expansion option. You've decided your personal hurdle rate. You will go forward only if the project can produce at least a 20% return. You make the following calculations. A new oven costs $50,000. Additional space in your existing building costs $50,000 to build out and would likely produce incremental annual profits of $20,000 after labor, material, and other operating costs. So you have $100,000 in upfront costs, the oven plus the build-out, and an expected annual profit of $20,000 for an expected return of 20%, right at your hurdle rate. You then turn your attention to the new store option. The upfront costs include an oven at a cost of $50,000 and $150,000 in build-out expenses. The scenarios for the new store are harder to predict. It's in a different part of town and so on, but you assess the potential annual profit at $50,000 to $75,000. So you calculate that you would spend $200,000 up front, and you would expect a return of 25 to 37.5%. This return, even at the lower end of the range, is clearly higher than the adjacent space option. But before deciding which path to take, you ask yourself some important, qualitative questions. The new store is in a different part of town, and there is greater risk that sales will be different than what you forecast. How comfortable are you with your estimates? Is the higher return enough to compensate for this additional uncertainty? The new store requires twice the investment of the expansion option. Can you raise the extra $100,000 for the new store option? And if so, at what cost? Conversely, are there hidden benefits to the new store? Does it, for instance, diversify your operations so that if sales decline in your existing store, you have some protection? Does opening a second store give you insight that allows you potentially to build a much larger company over time? These are the sorts of capital allocation questions and decisions that managers and entrepreneurs have to wrestle with every day, regardless of the size of the enterprise, although larger companies will often hire consultants and investment bankers to help them with the answers. And the same methodical, analytically oriented thought process is essential to both the baker and the Fortune 500 CEO in making effective decisions. This outsider approach, whether in a local business or a large corporate boardroom, doesn't seem that complicated. So why don't more people follow it? The answer is that it's harder than it looks. It's not easy to diverge from your peers, to ignore the institutional imperative. And in many ways, the business world is like a high school cafeteria clouded by peer pressure. Particularly during times of crisis, the natural instinctive reaction is to engage in what behaviorists call social proof and do what your peers are doing. In today's world of social media, instant messaging, and cacophonous cable shows, it's increasingly hard to cut through the noise, to step back and engage Kahneman's System 2, which is where a tool that's been much in the news lately can come in handy. The Outsider's Checklist. Checklists have proved to be extremely effective decision-making tools in fields as diverse as aviation, medicine, and construction. Their apparent simplicity belies their power, and thanks to Atul Gawande's excellent recent book, The Checklist Manifesto, their use is a hot topic these days. Checklists are a particularly effective form of choice architecture, working to promote analysis and rationality and eliminate the distractions that often cloud complex decisions. They are a systematic way to engage System 2, and for CEOs they can be highly effective vaccines, inoculating against conventional wisdom and the institutional imperative. Gawande advises that these lists are best kept to 10 items or fewer, and we will conclude with a checklist drawn from the experiences of these outsider CEOs to aid in making effective resource allocation decisions, and hopefully avoiding value-destroying ones. So, here we go. 1. The allocation process should be CEO-led, not delegated to finance or business development personnel. 2. Start by determining the hurdle rate, the minimum acceptable return for investment projects, one of the most important decisions any CEO makes. Comment: hurdle rates should be determined in reference to the set of opportunities available to the company, and should generally exceed the blended cost of equity and debt capital, usually in the mid-teens or higher. 3. Calculate returns for all internal and external investment alternatives, and rank them by return and risk. Calculations do not need to be perfectly precise. Use conservative assumptions. Comment: projects with higher risk, such as acquisitions, should require higher returns. Be very wary of the adjective strategic. It is often corporate code for low returns. 4. Calculate the return for stock repurchases. Require that acquisition returns meaningfully exceed this benchmark. Comment: while stock buybacks were a significant source of value creation for these outsider CEOs, they are not a panacea. Repurchases can also destroy value if they are made at exorbitant prices. 5. Focus on after-tax returns and run all transactions by tax counsel. 6. Determine acceptable, conservative cash and debt levels and run the company to stay within them. 7. Consider a decentralized organizational model. What is the ratio of people at corporate headquarters to total employees? How does this compare to your peer group? 8. Retain capital in the business only if you have confidence you can generate returns over time that are above your hurdle rate. 9. If you do not have potential high-return investment projects, consider paying a dividend. Be aware, however, that dividend decisions can be hard to reverse and that dividends can be tax inefficient. 10. When prices are extremely high, it's okay to consider selling businesses or stock. It's also okay to close underperforming business units if they are no longer capable of generating acceptable returns. Whether you are looking back or looking forward, the outsider approach to resource allocation offers a proven method for navigating the unpredictable, untidy world of business, one that has generated exceptional results across a wide variety of industries and market conditions. This checklist is a tool that can help any business, from the neighborhood bakery to the multinational conglomerate, adopt this proven approach and embrace the inherent uncertainty of the business world with open arms and fresh eyes. This has been an Audible Inc. production of The Outsiders, 8 Unconventional CEOs and Their Radically Rational Blueprint for Success. Written by William N. Thorndike, Jr. Narrated by Brian Troxell. Producer, Mike Charzik. Copyright 2012, William N. Thorndike, Jr. Production copyright 2013 by Audible Inc.